Ladies and gentlemen, good day and welcome to Mahindra & Mahindra Financial Services Limited Q3 FY22 earnings conference call hosted by IIFL Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Alpesh Mehta from IIFL Securities. Thank you and over to you, Mr. Mehta.
Thanks, Nirav. On behalf of IIFL Securities, I welcome you all to this 3Q and 9M FY22 earnings conference call of Mahindra & Mahindra Financial Services. The company is represented by Mr. Ramesh Iyer, Vice Chairman and Managing Director, Mr. Vivek Karve, CFO, Mr. Amit Rajay, Chief Operating Officer, Mr. Raul Rubello, Chief Operating Officer, Core Businesses, Mr. Dinesh Prajapati, Head Accounts, and Mr. Rajesh Vasudevan, Senior VP Accounts. Now, without much ado, I hand it over to Mr. Iyer for the opening comments and post which we will have a Q&A session. Thanks and over to you, sir.
Thank you. Good evening, everyone. Thank you for joining this call. So we had our results announced about an hour back. We had our board meeting and the results were announced an hour back. Just to give you a very summary of how the quarter has been for us, I would very strongly think that the quarter has been in line with what we had envisaged for the quarter, which is we were focusing on getting back to a growth in our core business as well as to focus on the collections and the recovery from the NPA accounts. And after our first quarter pressure, we had put out on how do we see the following quarters pan out. And we had kind of put out saying that by end of March, we should reverse at least 80% of the provisions that were made in the first quarter. And as we close the books in this quarter, we do see that we have been able to reverse upward of around 60% of the provisions that has been so far made. What is causing this to happen and how do we see it from here? Clearly, the segment that we are operating in and the geography that we are operating in has had a decent last 2 quarters. The economic activities have returned back to kind of, I would say, semi-normalcy, though not full normalcy, given certain segments didn't open up fully, but nevertheless, it was substantially better than what we saw in the first quarter. The monsoon turned out to be good. The harvest went by was very good. The yields are very supportive. The support price given is also equally good. But we do see that the cash flows from different state governments are being paid to the farmers on certain installment basis. But still there is a commitment. The crop has been brought and therefore we don't see a pressure arising from that segment. Rural sentiments are holding up positive. We are seeing demand for vehicles at the dealerships. We are continuing to see the footfall at the dealerships are increasing, but the problem truly is the non-availability of vehicles, and that is building some pressure on the aggressive disbursement which otherwise could have been achieved. The tractor business has seen some slowdown, and my understanding and belief is that it's at the back of the contracting segment yet not buying tractors or replacing their current tractors, and that therefore is causing a little pressure on the overall volume. But as otherwise, the farm side of tractor buying was very good. And I think it's important also to note that the previous year volumes on tractor had a very aggressive growth, and therefore one has to look at that base, and from where that we have to see how the growth is. On the commercial vehicle front, again, there has been a decent movement by the fleet operators. I think the less than 5 vehicle owners, etc., are still resisting the buying of new vehicles because possibly the vehicle price is too high and their economic viability is not something that is comfortable for them, and therefore we are yet not seeing buying happening in that segment. But overall, I would think that the volumes are picking up, and if the vehicles were to be made available, which is what we hear from the OEMs, that the vehicle availability will start improving, I think that should result into a good number even for us. All of this has led to our disbursement growth on the Pre-owned vehicle side, we have seen good traction. Again, demand is very, very high on the pre-owned vehicle side. But again, there the supply is a little weak with the new vehicle availability being a challenge. People are not offering to exchange their existing vehicle until there is an assurance of getting the new vehicle. So once that side starts improving, we can even see a reaction on that front. PD, we have seen good collection efficiencies, and we have been putting this out on a monthly basis. And in December, we actually had 100% collection efficiency, and in the quarter, we had upward of 95+% collection efficiency. So I think overall, the collection efficiencies have been good. Even if you look at our delinquent accounts, which moved into NPA in the first quarter, we have seen movement in very large percentage of the accounts. We have seen movement in collection. While, yes, people have not yet been able to clear their entire past due, but for sure they are able to service their monthly installment, and many of them are in fact also paying an additional installment, the reason why we are able to see the reversal of NPA happening clearly. I think therefore on the ground, the fact is that the customer cash flows have improved, demand continues to be robust, and that is helping us to kind of look at both business growth as well as collection and overall delinquent correction as the direction that we had set for ourselves after the first quarter, and we have seen that happen in both the quarter. During this period, we have regained our leadership position in the tractor business, given that the volumes of tractor at the various counters where we had a little pressure on the market share has been regained by us by putting in a specific team looking at that, specific analysis of various dealership as to where we had lost certain market share, and therefore what was needed to be done has been done with, and therefore that has also helped us regain the volumes in tractors and leading to an increase in market share. As a matter of fact, in every product we seem to have gained some market share, though not substantial in certain products, but every product has shown a trend of gaining market share, whether it is the Maruti range of vehicles or whether it is in the Mahindra auto segment, including the new product launches that Mahindra did of the 700 Thar, etc., which are a short supply product at this stage, and is a heavy competition to finance those products from every end. But given our relationship with the dealerships and our local presence out there, has helped us gain volumes even in that segment, and that adds to the overall volume. So we are confident at this stage to definitely make a statement that even going forward, you will see a growth trajectory from an overall disbursement is concerned, as well as our collection efficiencies will be maintained at the levels that we are, and we would see reversal of NPAs happening for sure the way we have projected. But of course, all this is at the back of the practices that we had so far with the new regulatory guidelines or guidelines that have come from RBI to look at NPA a little differently. I think it's important to recognize that on the ground for the customer, honestly, nothing changes with this kind of a regulatory change. Our practices will undergo definite change. The future products that we would launch will factor in this requirement, and therefore certain product designs will have to be done in a manner that can accommodate this. But because the current book is concerned, I think this will require a reapproach to aligning with the requirement and to meet the customer cash flow as to how do they behave, which way do they behave. So we have taken some very definitive actions in terms of setting up collection war rooms. We have kind of created separate teams for different contract segments, different product applications requiring a different approach to all of that. We have resorted to, talking to customer on negotiating and offering them some kind of settlements where they are able to bring in large installments. But all this is definitely going to be an effort on our side to ensure that the requirements are fully communicated to the consumer. So it's also about aligning themselves to this. But, as I said, as far as customer earnings, customer cash flows, customer overall business practices are not going to have a dynamic change because of this changed approach. It will have to be initiated from our side. On the overall cost front, I think various actions that we have put in place have worked in our favor, even at this enhanced level of business and at the enhanced level of collections, etc., we have still been able to retain our cost of operations to be around 2.7, 2.8 type levels. And once the volumes do pick up, I think we are a little invested into future in this. But once the overall volumes do pick up and the AUM starts to grow from here, we can definitely see the correction to this number further from where it is. So I think net, the point that we are making is that the businesses kind of come back and we are seeing growth, and we would continue to see a growth trajectory which will then lead to AUM growth. Clearly collection is speeding up, and that will lead to asset quality maintenance and improvement in the asset quality. And as was promised, we would see that 80% of the provisions are past getting reversed. The investment in the people front, both in terms of their capability building and competence building, is helping us productivity improvement, but also some specific actions on cost taken is yielding benefits of overall operating costs coming down. There's a lot of efforts that have gone into the data and the digital front. We have a very large team which is working on it, and there is a core team looking at how the core business and what percentage and what processes of the core business could be digitized, and that would further bring in a better improvement to the overall cost going forward. But more than that, ability to handle larger volumes into deeper pockets. Our penetrate continues, and we have identified to open another 150 odd branches during the year, and I think we will embark on that journey because we have identified several locations which require a more closer availability to the consumer, which could help us gain further volumes and improve the overall collection. On the liquidity front, we have not had any kind of pressure point. Sufficient funds have been available at a very competitive price for us, and that has helped improve the margin when it comes to our ability to borrow at the very, very fine rate. We are also sufficiently carrying liquidity buffer to be able to meet any challenges if it was to come. The pandemic wave 3 was a little scary to start with. I think there was this pressure on it spreading fast and it could have a serious impact, etc. But I think the good news so far is that there has been no major impact out of the third wave. The branches are all up and working. People are all on the streets able to meet customers. Customers are able to come to our branches. So all that is happening in a very normal manner, and the third wave has not had a serious impact, except in January. Of course, in different pockets, different markets, there were some temporary kind of a pressure that was going through, but nothing in a continuity basis like what we saw in the second wave. So even on that front, there seems to be a better comfort. Overall rural sentiment, I would kind of say that it is not still at its best. If we were to look at any past history, and if we were to say, has the rural come back to complete normalcy? I think we would say it with a little hesitation that it has come back to full normalcy. But that directionally we are able to see quarter on quarter things look better. So far there are no serious signals of things slowing down in a big way. Overall, people have become cautious when they want to acquire an asset or if they want to spend money on any kind of a consumption or whatever. People are little cautious. People are holding back some money for their future for sure. But it is far, far better than what we saw at the end of the second wave. So I think if I had put rural 3 on 10, I think we would be able to move the scale to say that rural is very clearly now at 6 on 10 or close to 7 on 10. But there is sufficient scope still to improve from where it is now that the schools are opening up. We are sure that the school bus operations will become good. Tourism centers are opening up, so the tourism will pick up. I think overall economic activities are beginning to happen. I think we are seeing a lot of directional talk about mining opening up, coal excavations beginning to happen. So I think all of this will contribute to the overall growth. So I still believe that there is sufficient action and activity on the ground to believe things will go positive. And we remain very positive to see that even this quarter that is in our hand, we'll see it that way. The month gone by has been a favorable month in all the fronts, and therefore that would remain to be the trend is what we believe, and therefore we could have a good quarter. We are very clearly reviewing the entire RBI guidelines as required. And as all of us know that the fourth quarter for us is always the best quarter, and we would see a good collection efficiency, a good NPA reversal, and therefore even under the IRAC norm, the gross NPA would stand corrected to a different level. And if there is a gap that we require to bridge by making any additional provision, we would be more than willing to do. As of 31st December, as you've seen, the provision required under IRAC and Ind AS as compared, we are carrying a much higher provision in the Ind AS since we have a high coverage of 52-53%. And in the end of the fourth quarter, there is a gap if we need to do, if we were to take the IRAC number as of today, and if we were to believe that will remain as it is, no movement whatsoever, then the worst case scenario is that we may need to do about a 1,500 crore kind of a number, which we don't think will be the reality. We will see substantial reversal to this number happening as well. But I just still want to make a mention that all this rule change, etc., will require a revisit to how we do certain things in future. But the fact of the matter is that the customer's business, customer's way of earning, customer's way of engaging his vehicle, developing his cash flows may not undergo any major change because of this. So I would stop here and then invite questions for us to be able to answer. I think the whole team is here, and therefore any questions that you may have will be jointly answered by all of us. Thank you, and over to you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Sanket Chheda from BNK Securities. Please go ahead.
Yeah, hi sir. My question was on your last update that maybe in Q4 we are likely to take 500 to 1500 crores of provision. So just wanted to understand how this number has been arrived. Is it like 500 is the best case and 1500 is the worst case? And if that 500 is best case, then why not take it in this quarter itself? So what has been the thought process and how this number has been arrived in particular?
Yeah, so I will give you my comment and then Vivek can add to that. So, what we have done is we have analyzed the NPA as of today, that is as of the December end, and we have seen how many customers are paying what kind of amount already. And if these customers were to continue to pay in the fourth quarter, how would they be in terms of their overall repayment, and therefore how many of them would actually come out of NPA 1 under the new guidelines. And there's a level of gross NPA that we would reach by that method. And therefore, why consider a provision when we are able to see very clearly that they are able to come out of already carrying an excess provision under the Ind AS. So we would want to give it a complete try this quarter to reverse them, get them collected. Even there could be settlements with customers. All of that actions will be put into place. And once that is done, and then if there is a gap and if that requires any provisions to be done, is what we would do. And that estimate has led us to believe that at the worst what it would be and at the best what it would be. Vivek, anything that you may want to add over what I said, you may please go ahead.
Yeah, you're absolutely right, Mr. Iyer. It would have been premature on our part to take any provision in the third quarter because our attempt will be to reduce the DNPA, which we have now informed the market at about 10,900 crore as of December end to a reasonably lower level. And we are all doing, when we said this about 500 crores to 1,500 crore provision, this is in order to bring our net NPA as per IRAC below 2%, so as to complete the norms. And therefore, we will definitely watch the ground during the fourth quarter, and based on what we are able to achieve by the quarter end, we will take a necessary provision. that's the reason that we did not take any premature action on this matter.
Okay, sir. So I'll put it the other way. Unless you see a case wherein you can reach this 6% under IRAC norms without any incremental provisioning, that is the 500 crores lower end that you have mentioned, is there a case wherein it is possible that you wouldn't have to even take that 500 also, and then it makes sense not to take in this quarter? Otherwise, if that is the best case, I think that should have been taken. So I wanted to ask whether such scenario exists wherein you would be able to reach this 6% under IRAC norm without taking any incremental provisioning.
So that's a judgment call we are making, because as I said, when we looked at how many accounts have shown movement in their repayment, even though they are not able to come out of the NPA in this quarter, and the fourth quarter is the best quarter for us from the overall customer collection possibility. And also we have aggressive programs of settling it with the customer where, we are negotiating and closing. And therefore the call is that if you reach the best case, there may be hardly anything required to be done. And therefore, like Vivek said, why take a jerk reaction rather than go through the process that we have put in place?
Okay. So the range that you are giving is on a very conservative basis that this could happen.
That's right. Like that 1500 is that, if nothing happens to the NPA that is today, then what will be required to be done?
Oh, okay. Cool. Understood. Thanks a lot, sir.
Thank you. The next question is from the line of Gaurav Kochar from Mirae Asset. Please go ahead.
Yeah, hi, good evening. I had just a couple of questions, just continuing from where Sanket left in the previous call. The total, if I look at the provisioning and the difference that you've given between the Ind AS and IRAC norms, and you mentioned 500 to 1500 crore as a number. So is that considering the write backs that you are taking, in the 4Q, about 500 odd crore write back that you'll be taking? So is that net of that number? So on a gross basis, is it 1000 to 2000 crore? Just wanted to understand, that 500 to 1500 crore number. And if I compare that to the slide number 25, wherein you've given the breakup of IRAC as well as Ind AS, that number looks slightly on the higher side. So the difference in absolute difference of stage 3 is 3700 odd crore. So even if I do a 40% sort of PCR, that number comes to the higher end of the guidance. So just wanted to understand that 1500 crore or 500 crore. How has that been arrived at?
So Vivek will explain, but you are right. Like at 3,000 crore, when I said that, let's say that today's NP under IRAC, nothing moves in the next quarter, right? Then the high end is that 1,500 number, right? And then we have made an estimate on what all can move, and therefore what can be the low, and can we even avoid any provision requirement. So Vivek can explain the logic of what you have specifically, but that's the way you need to look at it.
Yes, sir. Okay. I think that is correct. The estimates that we have put out are based on a certain assumption of how we see the gross NPA by end of the year, and that's exactly the reason that we have given a range, because sitting today it is difficult for us to predict what that number will be. But we wanted to be transparent with our investors and analysts. That's the reason that we have put out a range as on date.
Sure. So just, any color on what is the kind of, estimate on stage 3 as at the year end, which is resulting in only 500 crore. So is it 200 basis points, 300 basis points improvement in stage 3? Just wanted to understand the base case in case of 500 odd crore.
So I think our attempt will be to bring our gross stage 3 to the same absolute level that we started the year with at the beginning of this year.
Okay. Sure. So, stage 3 at the beginning of the year, if I'm not wrong, was 7%, sir, if I'm not wrong?
No, it was around 9%.
Okay, 9%. All right. Sure. So that was one. And just one more question. Just wanted to understand the collection efficiency that you've quoted for the quarter at 95. So once an account becomes an NPA, do you still keep billing that customer? How does that process work?
Oh yes, certainly. I think the account becoming an NPA and billing or not billing are very, very different matters. So the billing will definitely continue. And insofar as any account, whether it is in whichever stage it is, it pays, it gets into my numerator for calculating the collection efficiency. So collection efficiency is completely a subject matter of the current demand, which is the monthly demand that we raise, and the collections that we are able to make from the customer, both from the overdues as well as from the current demand for the month.
Okay, that current demand also includes NPL account. So the denominator of 100 will include the NPA demand also. Is that correct?
Certainly.
All right, sir. So in just that, in that context, I mean, can you throw some light on what would be the non-NPA collection efficiency? The blended collection efficiency is 95%. Just wanted to understand X of NPL or X of stage 3. What was the collection efficiency number?
And sorry, but at such granularity, we do not normally publish any number. So I will not be able to share that.
Okay. Sure, sir. Sure. Thanks and all the best.
Thank you. The next question is from the line of Rikin Shah from Credit Suisse. Please go ahead.
Thanks. My question is for Vivek. Vivek, if I look at the GNPA under the IRAC norms, it is currently around 17% and the net NPA is around 12%. Assuming that we make another 1,500 crores of provision and the gross NPA as per the IRAC doesn't change, the net NPA as per IRAC still comes down only to 9.7% by the next quarter. So just wanted to understand whether we are expecting. I mean, I'm just trying to reconcile earlier to Mr. Iyer's comment that even if the GNPA doesn't move at all, the maximum provisioning that we would need be only 1,500 crore.
So the way we look at it is like this. So our gross GNPA is 10,897. The IRAC required provisions for GNPA is 3,189. But you would also see there is 1,877 of overflow. That is the excess of Ind-AS provision over IRAC provision. And if you are appropriating this number to the GNPA, that number comes down to about 9.9%. And because what is this whole idea of IRAC provisioning? The whole idea is that we need to be below 6% at net NPA level, and we also need to be adequately provided for on all the standard assets. Insofar as the provision required to meet both these requirements is fully covered by the provisions that we are making under Ind-AS, we should be good. That's how we are looking at it as of now. And hence, we have put out a number of 500 crore to 1,500 crore, depending on the range of GNPA number that we should be able to reach by end of the year.
Okay, and this is helpful. And in this case, what we are saying is that if we appropriate this excess 1,877 crore, as of March, we would not have any excess provision over the IRAC, right? Then our Ind-AS provision would broadly be similar to IRAC.
You are right. We would be adequately covered. And while doing so, we would be achieving two targets. One, in Ind-AS, we would be below 4%, which was the regulatory expectation from RBI to bring that number below 4%. And as per the IRAC, we would be below 6% so as to meet the PCA norm.
Okay, thank you.
Yeah, thank you.
Thank you. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah. So on this moment of stage 3, when we look at it, there has been 1,800 odd crores which have got resolved. At the same time, there is huge net addition as well of almost 1,360 odd crores. So I'm not sure maybe how should one look at it, because I think last time it was quite contained and this is not even the forward flow. So anything to read into this?
Dinesh, Vivek, somebody's taking this?
Actually, I lost. If possible, if the question can be repeated.
Yeah, Vivek. So I was just checking that in terms of this stage 3 movement. Okay, so obviously there is a resolution of 1860 and there are forward flows of 340 odd crores. But still, there are net additions of almost 1360 odd crores, and that seems quite high compared to that of what we saw in Q2. So is it because of some unseasonal rainfalls or floods or any particular geography giving the pain, because this net additions seem to be on the higher side?
No, I would not call any specific reason for this. It typically happens, and insofar as the overall trend is decelerating, we should be okay with that, because the business is like this. The business is all about earn and pay. So there will be customers who will enter, the customers who will exit. However, insofar as the overall trend, which is what we have demonstrated, that from 12.7 we have brought it down to 11.3. And another thing is, while there would have been addition in Q3, it doesn't mean that these guys who entered stage 3 did not pay. So they have made a part payment. More than 50% of the exposure belongs to people who have done part payments during the quarter. So we don't want to read too much into it. This is business as usual, and this is how the earn and pay customers behave.
Okay. And maybe in terms of GNPA, so 10,897 is the current number, and for 6% we need to get the net towards 3,800 odd crores. And I think adjusting for the outstanding provisions which are there even under Ind AS, we are somewhere around 5,300 odd crores. So that's where maybe at the upper end we are saying it's 1,500 odd crores which can slip even if there is no recovery, which happens in Q4. So that's the
thing is absolutely correct.
Perfect. And what could be this number of GNPA as of September, and as of maybe net NPA? We have done some allocation from 3,200 to 3,700, so net NPA would have come out. But if I have to look at GNPA as of September, how much would that have been?
See, the thing is, this daily stamping started only effective.
Yeah, so you would have, okay.
So the IT system capability was ensured only from that day onwards.
Okay.
So other than that, the systems are not equipped to look at that data, to be very frank.
Sure. No, the only thing was almost 30% of stage 2 is something which is getting classified as GNPA, so which is maybe much higher, okay, compared to what we are looking at for peers. So I don't know, maybe is the collection efficiency out there quite comfortable, because when we look at it, the difference between GNPA and stage 3, and that is almost 30% of our stage 2 assets. So that seems to be quite high, yeah.
But I would say that is typically the nature of our customers. Our customers are, many of them are first-time borrowers, they are earn and pay vehicle, their cash flows are completely dependent on vehicle. So it is not unusual, and that is the reason why Mr. Iyer in his opening remarks said that if we need to control the GNPA flow forward going forward, we may need to re-examine the kind of cohorts that we would like to give loans to, or we may have to make certain amendments to the the way we collect from these customers. So these are the initiatives that we will take.
Yeah, I think.
Please stay connected. Line for the speaker dropped. Ladies and gentlemen, please stay connected. Also, you're reconnected. You may go ahead.
Sorry, am I audible now?
Yes.
Yeah, you're audible. Yeah.
We got cut off for a minute. So, did you hear me completely?
Yeah. We heard you completely.
Yeah. So that's perfect. Okay, and maybe even if like 20% of this comes back, 500 odd crores in terms of the reversal of the provisioning, then what will be required will get offset. Now, would that be the way to look at it? The way there has been the write back, and maybe whatever is the write off, that could be the hit to P&L in Q4 broadly.
That's right.
Okay, got it. Okay, thank you.
Thank you. The next question is from the line of Piran Engineer from CLSA. Please go ahead.
Yeah, hi. Congrats on the quarter. A couple of questions. Firstly, for Mr. Karve, the net NPL ratio we are targeting at 6% rather than 4%. Did I hear that right? And if so, why? Because then we can't pay out dividends, right?
So it is like this. These are two different ratios, first of all, that we are talking about. So one ratio is under NPA as per index, which is in the ECL terminology called stage 3. So we are targeting a net stage 3 below 4% because that was the regulatory expectation from RBI. That is point number one. Point number two is the net NPA below 6% is as per IRAP, and this is to comply with the PCA norm, which is the prompt corrective action norm. And it is not only for it's not just for the dividend, but it is basically to avoid any regulatory action or any regulatory interference from the, I would not call it interference, but I would say a greater degree of oversight from RBI. And
no, sir, I get that, but isn't the RBI norm, doesn't it state that if you had more than 6% net NPL in the past 3 years, then you have to get it down to 4% in order to pay dividend?
No, no. In fact, if you look at the extant regulations of RBI on dividend payment, they actually talk about 6% only. They don't talk about 4%.
Okay. And just to clarify from an accounting perspective, this 500 to 1500 crore hit is going to go through the P&L. It won't be like an adjustment to impairment reserve or any such sort of accounting adjustment, right?
No. So it will be by way of a management overlay provision.
Got it. Yeah. Since firstly, we did restructuring in 1Q, which had a 6-month sort of window where we pay lower EMI. I know it's too early to say, but can you talk about how collection trends from that restructured book has been now that it has come out of that 6-month sort of moratorium?
So I think this is one area that we continuously monitor. As of now, we don't believe there is any reason for us to be very concerned about it, but this is an area that we will keep watching. And any curing that we do out of this pool will be completely a function of how do these accounts behave. Because quite separately, RBI has already come out with a formula wherein how the curing should happen, and we will also watch the payment behavior of these customers, and accordingly we will take a curing. In any case, by end of Q3, that is December 31st, no curing has been there. So the only change in the structured accounts has happened either because the accounts have got settled, closed, or the accounts by natural progression have moved into stage 3.
Got it. And just lastly, if you could elaborate more about your collection war room, as in, how is it structured, how many people, just some more details would really help. And if you've really changed some underwriting practices in the past 18 months, maybe in terms of LTVs, maybe in terms of avoiding certain types of products or people. Because the idea is that once all of this is over, COVID is over and this year is done, then on a steady state basis, do we get back to, say, a sub 2% credit cost, or how do we think about, say, beyond the next 2-3 quarters?
So I'll ask Rahul to explain the collection war room and the credit parameter changes and how we're using data for better decision making. Rahul, you are there on the call?
Yes, sir, I'm there.
Yeah, can you go ahead? Can you explain the war room concept and how we have set it up and what we are doing?
Sure. So the collection war room, as you all aware, was set up after Q1, and the objectives largely were to look at how collections can play a very active role in proactively seeing how the forward flows can be mitigated, as well as recover as much as possible from the existing stage 3. So how we've gone about it, we do have a large collection team, and this collection team has been enabled with a lot of data insights on how to create cohorts of customers, more visibility on how these customers' contracts behave, not just on Mahindra Finance, but also how they behave on other lenders. And accordingly, each of these cohorts are dealt with differently. So our whole collection mechanisms, the way in which we approach customers for even settlements, and where we have to use legal tools maybe for repossession, all that is streamlined basis this central nervous system that we created at corporate office. Having said that, the collection war room continues to operate with full throttle even now, considering we had committed, as Mr. Iyer said, to get back to our GNPA levels of last year. That means we'll have to reverse significant amount of provision. So the collection war room, besides doing the whole collection activity, also is looking at incremental business, whether we are, for example, a large number of our customers are new to credit. So the way in which we underwrite these customers definitely have got revisited. We are looking at enablers at onboarding itself, and whether it is LT, whether it is etc. All of that also is baked into our new onboarding.
Okay. And on the underwriting parameters, or if anything has really changed?
Sorry? Can you
Sorry
repeat
to
that?
interrupt you. I'll request you to come back in the question queue for a follow-up question. I request all the participants, please restrict to one question per participant. If time permit, please come back in the question queue for a follow-up question. The next question is from the line of Karthik Chellappa from Buena Vista Fund Management. Please go ahead.
Yeah, thank you for the opportunity, sir. As far as the increase in the stage 3 is concerned in IRAC compared to Ind AS of 3,674 crore, which is the product that is contributing maximum to this increase?
So this will be across segments, Karthik.
So it's not like a segment like tractor or something is contributing maximum to this increase. There is no specific product category or segment, is it, which is contributing to this increase?
I don't think so. See, as even in the past we have explained, our NPAs or our collections are more geographical impact rather than really truly product impact. Except, of course, when certain times, as we explained, the last 3 or 4 segments which are not done well. So even within the increased NPA, you will see a similar pattern that you see for our basic NPA. It will not be skewed towards any particular product or anything.
Got it. And given that the increase has come maximum from stage 2 to stage 3, why have we taken down our coverage ratio on stage 2?
Sorry, are you saying we have taken our coverage down on stage 2?
Yes, from 13.6 to 12.7. So if you look at the reduction in stage 3 loans and the reduction in provisions, it's actually slightly disproportional. But given that we still have about a 500 to 1,500 crore of buffer, which we are expecting in 4Q, why did we choose to reduce the coverage on stage 2?
No, so there are two things here. What we do is there is a quarterly refresh that keeps happening on the LGD and PD ratios, and this is a feature which is there on a quarterly basis. So based on that, there could be some movement in the underlying ECL model itself. That is point number 1. And point number 2, if any of the restructured assets have by natural progression moved into stage 3, so while the coverage on stage 2 will come down, but actually as they enter stage 3, the coverage under stage 3 will go up.
Okay, this is very clear. Okay, thank you very much, sir, and wish you and the team all the very best.
Thank you. The next question is from the line of Nischint Chawathe from Kotak Securities Limited. Please go ahead.
Hi, am I audible?
Yeah, Nischint, yeah.
This is actually on the cost of funding. It looks like there was a sharp decline in the cost of funding this quarter. So just kind of curious what really happened and what proportion of your total borrowings are linked to external benchmarks?
Nischint, can I request you to repeat what you just mentioned?
No, he's saying your cost of funds have come down during this quarter, and what percentage of your borrowing is linked to the external environment linkages, and has anything specific happened because of which your cost of borrowing has come down? Nischint, that was your question, right?
That's right.
Vivek, should I go ahead and answer it?
Yeah, please.
Go ahead.
Yeah. So Nischint, as you would have been noticing, that we have an advantage of underlying asset which qualifies for a PSL. So we continue to get a very decent pricing from the marketplace for our not only on-lending PSL from the banking system, but also a decent securitization deal which we have been doing every quarter. So that is definitely helping us reduce the borrowing cost. At the same time, overall market had been quite liquid, and which also enabled us to continue to borrow at a very, very decent price. To your point on the last point, what you specified, Nishin?
What proportion of your...
Yeah, around 17% of our borrowing is linked to the external benchmark, which is either to repo or the T-bill.
And in anticipation of rise in some of these benchmarks, have you kind of effected a rate hike on the asset side?
So not yet, but we are in the process of putting out our prices from the end of this quarter. We won't want to do it immediately because there is still an advantage of the overall cost of money. But as we start seeing that fresh borrowing starts to happen at a new rate, then we would also start pushing up our rate accordingly. Dinesh, maybe there's one more reason it could have come down is some of your past borrowings, which were high rate borrowings, would have matured and you would have replaced with a new borrowing at a low rate.
That's true. In fact, there is still a scope for us to continue to see that our cost of fund may continue to remain lower, because our mix of borrowing, if you see our short-term borrowing continues to be at a very, very low. So incrementally, we have a scope to borrow through the short-term source.
Sure. Thank you very much and all the best.
Thank you.
Thank you. The next question is from the line of Mihir Ajmera from Enam Holdings. Please go ahead.
Hello. Hello.
Amir, you're not audible.
Hello.
Amir, may I request you to speak through the handset?
Is it? Hello.
Go ahead.
Hello. No, there's a lot of disturbance. Maybe we want to take the next question, then Mir can come back maybe.
Thank you. Mir, I request you to come back in the question queue. The next question is from the line of Mayank Gupta from Citadel. Please go ahead.
Hi, sir. Thanks for taking my question. So this 3,700 crore extra that we are sort of showing, how much of this is coming from the impact of, reversing the NPL upgrades versus the impact of daily stamping that we might have seen in the last 1 or 2 months?
Dinesh, anybody has got that breakup?
Between the gross stage 3 and gross NPA, right?
No, he's saying that 7,000 versus 10,000. The difference is coming from daily stamping. How much?
Account of daily stamping only, because these are the accounts which, as per our ECL model, not stage 3. So in terms of their aging, they are below 90 DPD. But because they had touched 90 DPD and they have not come back to 0 DPD, they are being classified as NPA under the IRAC norms.
Got it.
Hope I have been able to clarify.
Got it. But so what I wanted to ask was 2 things, that over the next 3 months, would there be certain accounts which are 0 DPD right now or might miss? No, the question essentially that I want to ask is that, typically in Q4 we see a lot of recoveries, a lot of NPL upgradations because people pay up. This time around, because of the NPL upgradation norms, will we be able to see the same sort of recovery that we have seen in the past Q4s?
So far as the stage 3 is concerned, you will see the same. But as far as the IRAC NPL, which is why we have taken the additional range of provision that we may have to do in case they don't completely reverse.
Got it. And just to confirm, you said that the target is to keep net NPL at 6% and net stage 3 at 4%, right?
That's right.
But wouldn't that mean that our IRAC, that the total provisions that we hold under IRAC would be lower than the provisions that we hold under Ind AS if you're keeping net NPL at 6 and stage 3 at 4?
No. If you look at our Ind AS, I think we have a 50-53% cover, right? Under the IRAC, the provision norms are very different from the way the stage 3 provision norms are under ECL. Vivek, is that right? You may want to clarify. That's the reason that IRAC will always be lower than the Ind AS requirement, right?
Yes, you are right. And also, you look at it this way, that as on date we have an excess provision of 1,900 crore, and the estimate of 500 to 1,500 that we have put out is after utilizing this excess. So we are primarily looking at a scenario that in order to comply with both the ratios of below 4% under Ind AS and below 6% under NNPA, we may not have any excess of Ind AS over IRAC, but we will be adequately covered at the same time.
Got it. So just if I can slip in one last question, and this is more sort of the business construct or the change in business that you're talking about to manage these RBI NPL norms. Now, what I understand is that a lot of our cash flow is, or the customer's cash flow is agri-based. And I understand that, banks, when they lend to agri segments, they get to collect or they get to recognize NPLs in terms of cash crop cycles or crop cycles, logically, because that is how the customers make money. So given this constraint, how are we going to be able to collect money on a monthly basis from the customers? Because this essentially creates a disparity between how regularly we will collect money from the same customer versus how regularly the bank needs to collect money. And are we representing this to the RBI? Because this clearly seems to be a disparity here.
If I may to attempt that, you are right that banks can, specifically this they do for their agriculture loans, which is crop loans, where they have a 365-day norm of even recognition of NPA. But when it comes to structuring loans to underlying customers whose cash flows are dependent on agriculture, especially our tractor portfolio, there too we are able to match the repayment cycle to mimic the cash flows of the customer. The difference only will be in the recognition of NPA, which banks probably, especially for their crop loans, have a slightly longer duration to recognize NPA.
Understood. All right. That's it from us. Thank you so much.
Thank you. The next question is from the line of Dhaval Gara from Aditya Birla Asset Management. Please go ahead.
Thank you for the opportunity. Just one important thing. You could talk about the growth momentum.
And your voice is breaking slightly.
Sorry, am I audible now?
Yes.
Sorry, just one question. If you could talk about growth momentum coming back, we see improvement or pickup in disbursement, but last 4 or 5 quarters there is a lot of noise or stoppages in work because of COVID waves. So if you could talk about what type of trend do we expect in the next 12 months when it comes to growth and pickup in disbursement and therefore AUM growth?
So clearly, if you see, I alluded to this even in my beginning comments, which is, we have started seeing gaining market share in almost all the OEM product lines. We are seeing definitely demand up there, and once the vehicle availability improves, we should start seeing growth continuing in the all segments that we are looking at, and we are very bullish about the pre-owned vehicle, that is refinancing. That is, we are very bullish because the demand there is very, very high. We also see very clearly that the commercial vehicle pickup is beginning to happen, though slowly, but that will begin to happen. And last whole year, we had not done much of commercial vehicle lending at all. And with the revised product offerings to certain high-end customer at the rural segment, we are able to also get traction from high-end customers in rural through our smart branches and through our digital initiatives, etc. and our additional branch network that we are looking at to go more deeper. Put all this together, I think maintaining the growth of around 20-25% is very clearly visible, but of course subject to availability of vehicle, etc. The only area where we see there is a little slowdown at this stage is the tractor volumes. But as I said, we are even confident there that once the contracting segments do start participating in the tractor purchase, that would also start adding up. So apart from the fact that, 1 year, 1.5 year back, definitely our focus was more on collection, one. Two, the rural was resisting and not adding too much of buying there. That was adding to some volume drop that we had. And certain segments were not buying at all. And I'm very reasonably sure that once things open up, like you said, once the COVID is behind us and the tourism starts to happen, schools begin to happen, all those segments will come back to start buying vehicles, which are very strongly our segment of customer. So I think our confidence is high in terms of disbursement growth beginning to happen, leading to AUM growth. Is something that we are very confident of. We are seeing it on the ground, things beginning to change. And we will watch it by the month, not even by the quarter. And we are already seeing benefits of that flowing towards us. Rahul, anything else that you may want to add in terms of any particular geography, product?
No, sir, I concur with your view. I think you've covered it.
So the strong disbursement growth should translate into growth. Are you seeing the change of repayment cycle also moving in tandem to improve the AUM growth?
Sorry, what will change? You said I missed the word. I don't know if somebody else heard it.
What I'm trying to understand is that the strong disbursement-based growth should translate into AUM growth as well in the coming year?
Yes, it should, because so far the AUM has been a little stagnant because the recoveries have been much higher than the overall growth that has been happening.
Right.
Once the disbursement growth starts to happen more strongly, even though collection should be maintained at a high efficiency level, but the net will start adding to AUM.
So you believe that 20-25% type of disbursement growth in FY23 is very much possible?
I would strongly think so, because the market would support. I think, what we have seen the previous year is a large part of non-availability of vehicle has played its role. And run up to the next election, next 3 years, we would see buoyancy in rural and, with infrastructure opening up and focus on various infrastructure projects. I think all of that will add to the rural consumption, at least when it comes to vehicles like pickup, LCVs, the JCB kind of backhoe loader. These kind of products will all start doing well in the next 3 years. I mean, run up from now to the next 3 years.
So just if I can push one more question, your outlook on net interest margins and how are we placed, say, from point of view that there could be some slight increase in rates either by the regulator or the short-term rates moving up already to some extent. What would be our stance, and do we expect margins to remain stable?
So 2 or 3 ways of looking at it. One is we will continuously look at our product mix on the borrowing side to see how do we remain the most efficient. And like Dinesh explained, our assets do qualify priority sector, so the securitization routes do continue to give us the advantage of borrowing cost. Second is some of our fast borrowing, which are actually high cost borrowing, even when replaced now, the current rates at which we would borrow would definitely be possibly lower than the rates at which it has been averaged out in the past. So therefore, even though the current rates may slightly go up, it may not actually increase our borrowing cost overall. The third is, once the borrowing cost starts to move up, the market does allow you to price yourself for future lending also accordingly. And we have always maintained this stand. If just about 15-20 basis points go up, we won't change our lending rate. But if we do see that kind of a stance and we see 20-30 basis points and go beyond that, then we will also offer new rates to the customer. And the last is, our focus is going to be little higher also on the pre-owned vehicle financing, which comes as a different yield. And we have become, once more, we have become number one financier for tractor. The tractors also come at a little higher yield. So that product mix change also will increase our overall yield at the lending level. Put all this together, I think to protect the margins at which we are operating, even when the rates were to slightly go up, is not our major worry at this stage.
Sure. Thanks a lot for your time.
Thank you very much. Ladies and gentlemen, that would be the last question for today. I now hand the conference over to Mr. Alpesh Mehta for closing comments.
Thanks, Nirav, and thanks everyone for joining. Thanks everyone and the management for joining on this conference call. Thank you.
Thank you. Thank you,
Thank
everybody.
you.
Thanks a lot.
Thank you. Thank you all for patiently listening to us. Thank you so much.
Thank you very much. On behalf of IIFL Securities Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.